All right, so welcome everyone. This is our first quarter Carfax meeting. Just as a reminder, according to the board's direction and the schedule we have, there will be 4 quarterly meetings that will be recorded, such as this. We're now being recorded, and then will be rebroadcast live and streamed through on the Township's channel and the Township's various social media platforms. So thanks everyone for being available. And I'll just rehash real quickly. Colleen Deere is with Mock and Hop Benefits Group. They are the appointed actuary for the Township, now celebrating their 30th year servicing Radnor Township.
Yeah.
And in their capacity of doing all the actuarial work for the defined benefit pension plans. And then in the past, I guess, 9 or so years, when the OPEB trust was created, then began doing the actuarial work on the OPEB trust and the liability calculations based on the Township's actual data and some of the projected cost data. So tonight, and just a real quick recap on the project, at the direction of the board, the board would like for our group to get familiar with the OPEB liability, understanding what it is and why we have it, and possibly come up with some recommendations related to a funding plan. Whether it's fund nothing, fund something, fund a lot of it. It's still a wide open topic for our group to opine on and really just kind of learn more about it. I thought for tonight, having Colleen available and maybe just for about an hour, I'm not sure, that Colleen can step us through the last actuarial valuation report, which was dated 1/1/2019. And then there was an update done just recently, and I forwarded that report around just last, I guess in the past few days. That has some updated valuation and a little bit of analysis on, if we were to change some of our assumptions. But that's where we are, and I thought, Colleen, if you would, kind of give us a broad overview of that report.
Mm-hmm.
And we can talk about what goes into it and then address any of the questions, some of them, whatever you want to get through. If anything you need to get back to us on, that's fine too. And before we go any further, we got Emily jumping on. I will.
There she is.
Yeah.
Hi, sorry about that.
Hi, Emily. How are
Hello,
you?
Emily.
I'm doing okay. How's everybody doing?
Doing all right.
We're holding tough here.
Good to see you. In a matter of,
Or not see you.
we're not seeing you. Glad you could make it.
It's the special meeting, so I made the effort.
Thank you so much. So, Emily, meet Lauren, who's
Hi,
a new
Lauren.
addition. I don't believe you guys have met. And Colleen, who's going to be taking us through the actuarial report that they've prepared, as well as a bunch of questions, which if you check your email, you will have just received from Bob Tate. Those were prepared by Tony, thankfully. Thank you, Tony. And very thoughtful questions at that, I think. So, Colleen, I know your time is very valuable. So if Bob, you're good, should we just get started with that?
Yeah, and since Emily just jumped on, I just wanted to remind Emily that this is the first quarterly meeting for Carfax, which means this is the one it's being recorded, and then we will rebroadcast through the various social media outlets available to the public.
Very well, great.
That's per the board's direction and this group's charter.
Okay.
So,
Colleen,
Hi.
how would you like to go through this, just so we can get oriented?
Yeah, I was gonna first just maybe step back and just give a little bit of background on the OPEB and how that, how it came about and how it compares to the pension plans first, if that's okay. And then I'll make some specific references to the valuation report.
Sure, great.
Yeah, so, everybody is pretty familiar with pension plans in general, defined benefit plans where the employees, have a set retirement date, they're going to get a pension. And under state law, there's a requirement that you fund those plans. You put in a certain contribution every year to maintain the funding status so that all the money is available there when each person retires to fund their, lifetime of benefits. And they've been around for a long time, and there's state laws that say, you have to submit certain reports and meet certain funding levels. Whereas OPEB, which is other post-employment benefits, things like medical, dental, vision benefits that are paid to retirees after they leave employment, is similar in that those benefits are also paid after retirement. However, the big difference is there is no state law or any other requirements that they be pre-funded. However, the Governmental Accounting Standards Board has taken the position that despite that there's no requirements to fund them, like pension benefits, they are benefits that employees earn over their career and therefore should be accounted for as far as the cost of them over their career as well. And that's kind of how it came about that these valuations had to be done. So these valuations are being done kind of similar to a pension and assigning costs over the employee's lifetime, although there's no mandate that they be funded. And probably I would say, a majority of the local government plans that we work with in Pennsylvania, we work with, hundreds of plans, do not pre-fund them. There's a lot of pros and cons for pre-funding, but we'll get into a little bit of that later, but at one time, there were no valuations done on OPEB benefits because there was no requirement. And for the most part, most governments just what we call did pay as you go. They were kind of treated almost just like active employees along. So you were paying their premiums along with all the active members ongoing. So the impetus behind all this thought about pre-funding and accounting for these costs and putting them on the financial statements came about because of the Governmental Accounting Standards Board. Even though there are those requirements for reporting on your financial statements, there still is, like I said, no mandate that you fund it. And if you do fund it, there's no requirement to say how you do or don't do it. There are requirements, though, that based on your decision to fund or not fund and what level you decide to fund, of what assumptions have to be used for reporting those liabilities. And these reports that that we're going to be looking at are prepared mainly under those Governmental Accounting Standards Board rules. And we have talked with the township in the past and with the previous Carfax group that we can also run these numbers different ways than how we do it for this GASB report to determine how you want to fit it into your funding schedule or how you want to do that. So when we're looking at these numbers, keep in mind, these are prepared for GASB purposes. We can cut and slice and look at them all different ways based on what you guys want to do and how you decide to go about doing that. And one of the biggest factors that comes into play in what these liabilities end up being is the discount rate that we use to discount those future benefits to today's dollars. And these GASB rules have changed quite a bit over the years. When we first started out doing these reports, they were completely different. What we're looking at now under the current GASB rules, there's a lot more regulations in how you can determine those rates. So that's why they're a little bit more set in stone, and why, if you actually wanted to do funding, we could look, use different rates to calculate those. And in the past, we have done a lot of those scenarios and looking at this for the township. So that being said, this report is a result of us trying to project out into the future all the expected OPEB benefits that would be paid to your employees, whether they're retired or active right now, and discounting them at those rates specified by GASB, and then spreading those costs over the career of each person. So at each valuation date we're looking at, we're saying, you know, what is the theoretical accrued liability so far that's been earned by the current employees. And so for a retiree, you know, of course, their entire benefit has been earned. And for some of them have already been paid. For the actives, it's just what has been earned up to this point in their career. So that's where you'll see a difference between the total present value of benefits and the accrued liability numbers. And my main focus as far as looking at those numbers would be on page 5-1 of the valuation. And I don't know if it'd be easier for me to share a screen, or if you all already have it all set up as an aside, I can refer to the page numbers, or I can pull it up on here.
Right. Actually, I think we all have the documents. I know we all have the documents in multiple screens, but it might be easier to see exactly what you're looking at, so we're not jumping around, and we can.
And,
If you
and
wouldn't
for the benefit of our recording, I think it would be,
Right.
it'd be really good that we show this.
And there's that. Yeah.
Yeah.
Yeah, forgot about that. Yep. Okay. Okay. Are you seeing that? It's hard for me to tell.
Yes.
Okay.
Yep.
Clearly. No, that looks good.
Okay. So yeah, this is the page that, that I would typically look at. And this is just a snapshot as of January 1st, 2019 of all the liabilities. And at the top on number 1 here, present value future benefits, that's what I was referring to initially as it's actually the total present value of all future benefit payments of all active and retired members that are expected to be paid based on the assumptions that we're using for the valuation. So as of January 1st, 2019, the total for all groups combined for active and retired is $69,266,000. And we have that broken down, of course, by the police group and by the civilian group and by active and retired. So you can see that.
Just a quick question. You had mentioned that this was for post-retirement.
For post-retirement benefits, yes. Benefits will be paid to people after retirement.
Okay. So when you have active in there, that's just the expected future liability.
Correct. Yep. Okay. Correct. And then number 2 is.
Colleen, can I just throw in a question? Probably.
Sure.
Just for clarification, since this is the present value, does that imply if we had $69 million today and put it in the bank, we're fully funded, not counting the existing assets? Am I?
Yes, if you hired no new employees and it was just covering the current active and retirees, you put that in the plan and it earned exactly the rate of return that we're assuming, and all the other assumptions came true about future medical cost increases and so forth. Yes.
Gotcha. So
Yeah.
the roughly 100 retirees and roughly, I guess, probably another 100 between police and civilian, maybe a little more, who are active and eligible to retire with these benefits.
Yeah, here's the breakdown of the
Great. There you go. So, and again, it's just counting the cost once they retire.
oops. Say that again.
So even though it says, I think dovetailing on Lauren's point, where you say active members, that's somebody working here today, but that's counting the cost that's going to occur at the point of their retirement somewhere in the future.
Yes.
Got it. Okay.
But I'm assuming these numbers don't come with names because we're expecting some hires and some people leaving this world, et cetera. Like there's tons of assumptions behind these numbers. This is just some
Correct.
averages based on what you've seen, what you expect to happen. There are no specific names to go with these.
Well, I mean, we are using actual data, but we're applying assumptions to them, yes. So yeah, certain percentage we're assuming like will not stay till retirement. We're assuming a certain percentage will retire at this age versus that age. Yes, some will be married, some won't be married. So yeah, the assumptions are applied to the group, but we have actual data behind that of the current employees and their ages and so forth. So then number 2, which is referring to total OPEB liability, because that's the GASB term. It's in the normal world, we've referred to that as the actual accrued liability, or the amount of costs assigned to past service for these benefits. So in other words, if you were funding it like in the pension plan, you would only need to have this much money in at this point to be on track with your funding. On that basis, the total liabilities would be $53,589,000. The fiduciary net position, which is again a GASB term, but it's the market value of assets as of January 1st, 2019 was $7,031,000 or $7,031,000. And then the net OPEB liability is what the unfunded portion of that would be, or $46,558,000.
Colleen, question. Would you explain to me again what the difference is between number 1 and number 2?
Yeah, so we take all the costs of somebody's benefits, the total, all the future payments to each participant, and took it to the present value. That's the top number, the 69 million.
And it's discounted at what rate?
Discounted at 4.25%. And then if we took out those costs, spread it out over each participant's career, and you were making contributions each year, the amount of money you would need to have to be on track with the funding as of the valuation date, you know, anticipating there would be costs paid in the future for those active people, that accrued liability is the 53 million. So on the pension side, we look at that 53 million as being how much money you would need to have in the plan to be 100% funded. Not fully funded, meaning you've paid all future costs, just how much of the costs have been assigned to the past service of all your participants. So when I was saying before about how GASB came out with the opinion that you need to recognize costs of participants while they're working over their career, we would assign like a cost to each person for each year they're working, like they're earning another year of benefit towards their benefits to be on track with the funding as of the valuation date. That's the accrued liability. In fact, that amount at the bottom is called normal cost. That is the cost we assign to a 1 year of service. So in other words, as a group, the year of service they would be earning for the valuation year costs $1,347,907. So if you were actually funding it, trying to fully fund it so that all the money would be there at the time of expected retirement, like we do on the pension side, the contribution you would be putting in for 2019 would have been $1,347,907. And if you would have put in the normal costs for all past years and contributed them and they earn interest, that's the accrued liability number. So it's kind of like the sum of all the costs for all prior years, if that makes sense.
So number 1 is we've got all these people we're accounting for, and if we take all the benefits that we're going to have to pay them until the last one is out of the system, that's the $69 million number. And then
without having to put any more money in,
the 53.5 million is as of today if we stop the plan. And we didn't add anything else to the plan. And nobody got any more service, yada, yada, yada. This is what we would owe them anyway. Is that right?
Kind of like that, yeah. I mean, it's not exactly, but yeah.
When does the liability stop, I guess is the question. What is the definition of this liability? Time.
Yeah, well, so that's one other thing that's different about OPEBs than pensions. So like on a pension plan, if somebody is vested and they quit today instead of, 10 years when they're eligible to retire, they're going to get a partial pension. And so the plan, would be funding for that partial pension. Whereas in the OPEB, it's a little different because even though we're assigning, we're kind of looking at it as if they're earning a part of their OPEB benefit each year. And we're breaking it down that way as far as the costs. If they actually, there's no vesting in an OPEB plan. So if they actually quit, they may get nothing. Whereas in the pension, they might get a partial benefit.
So I guess what we're asking is, would it be possible to see the assumptions behind this without getting into individual names? Like what are your sort of category assumptions for this? I think that would answer
Yeah.
some questions.
Okay, so let's look at that.
Oh, okay.
And I would assume that one of the assumptions to Jay's point is that people will leave. That's what Colleen had already confirmed.
Yeah. Okay, so there's a lot of assumptions behind this. I don't want to dig too deep into this, but feel free to ask questions as we go through it. One of the biggest, most impactful assumptions we make are actually a couple of them here on the first page, including the medical the trend rate assumptions, in other words, what the assumed increases will be in the various different benefits. Medical is the biggest one, of course, and the expected rate of return on assets, and which ties into the discount rate. So when we were preparing the 2019 valuation, I guess we already knew probably what the 2020 rates were going to be. So we actually factored in the actual change for that first year. That's why it looks odd where there's a negative 3% from 2019 as the trend rate. But then going forward, you can see the various different assumptions we were making for the different categories of things. So for the medical and vision, we were assuming a fixed 5% rate going forward. For the prescription drug part of the benefits, it was a decreasing rate with the ultimate rate of 5% from 2026 and thereafter. And then for dental, flat 3% per year.
Is this, I guess you're planning as a worst case scenario, correct? I mean,
it's not supposed to be a worst case scenario. It's supposed to be theoretically a best estimate, but
but you're erring on the side of caution with these.
erring on the conservative side, yeah.
Because if this is compounded, it gets exponential pretty quickly.
Mm-hmm.
Colleen, just to be clear, for medical and vision, we're saying it's 5% is the rate. That includes the 2.75% inflation.
Yes. All these rates include inflation.
Okay, so we expect it to be 2.25% higher than the inflation rate.
Yeah, so we're just disclosing that because it's also required under GASB, but as the underlying rate to the other economic assumptions.
Okay, and this is compounded annually as you have it there, right?
Yes. Yep.
Thank you.
Yep.
And the long-term expected rate of return is real. That's got no inflation in it. The discount rate then includes inflation, and it allocates and it calculates the return, the real return, by percentage of our assets.
Actually, no, the long-term expected rate of return it does include inflation. The difference between that and the discount rate is that, again, this is a GASB rule, that we discount the future benefit payments at the that can be funded by the plan assets at the long-term expected rate of return on those assets to the extent that they can fund those benefits. Anything that would, based on that, would be beyond that. In other words, the assets aren't enough to pay any benefits after that. We have to discount those at the rate, at the bond rates. And that's
how much is that? What is that rate?
That's what we're showing here. It's
okay, so that 4.25, it's got some period of time where it's based on the real rate of return we expect plus inflation, and it's got some period of time where it's this 20-year municipal bond rate.
Right. And what we had calculated at that time is that the assets as of the valuation date would be available to fund benefits for 18 years. So 18 years of benefits were discounted at the long-term expected rate of return of 6.25%. The rest of the benefits, future benefits, were discounted at the 4.25%.
And what is the, I'm sorry, maybe you said it and I just missed it. What is the bond rate
Oh, wait.
for year 19 and forward? What is that bond rate?
So
Let's see. I think it was 3%, but I'd have to double check on that. So yeah, the discount rate is the aggregated
I
rate.
got it, okay. Now, again, the long-term rate, the long-term expected rate has no inflation in it. So equities will outperform inflation by 6%. That's the assumption. Or it's at 6% plus minus 2.25% rather, 2.75%. Following? Does the 6%
Yeah.
include inflation or not include inflation?
Oh yeah, it must not, because yeah, with the 6.25 is higher, yes. So yeah, that's the real rate of return. The
Now, I'm really thoroughly confused now. I mean, I think, when I think about making investments, I think that what we have is equity is the long-term expected rate of return on equity is 6%. The long-term above inflation, long-term return on
Yes,
fixed income
that
is
is-
2% above inflation.
That's right. Yes, that is
So
what
those
it's
numbers
saying.
are based no inflation. The 6.25 has inflation in it.
Yes, yes.
Okay. Okay. And the discount rate is based on the 6.25 plus the 20-year. So it's a hybrid of those two things.
Yes. With the 18 years being the break.
Right. So,
Mhm.
I mean, one of the things that I think you sort of alluded to this, Colleen, in your opening comments, that what we've got here is we've got a regulatory construct of how you calculate all these numbers. And this is what GAP says you should do. And our analysis is going to be an economic analysis that, for example, I mean, there's no way in the world that I would say, geez, we ought to think about that 20-year treasury or that 20-year municipal bond in year 19 and beyond. It's, here's how we can invest the money. It's going to be that way forever and go forward. Make sense? Is that a fair statement to make?
Mm-hmm. Yeah, so, and this also assumes that essentially that no future contributions will be made. So if for example, you had a funding policy where the township had a written policy, they were going to put in, the actuarially required contribution or actuarially determined contribution every year going forward, we would probably then anticipate that all future benefit payments would be funded by assets, and therefore the discount rate would be equal to the long-term expected rate of return.
Yeah, okay. Yeah. That makes sense.
Which that's why I was saying before, it makes a big difference what the funding policy is as far as what discount rate we can use for GASB purposes.
And could you, can you in 30 seconds explain, how does our $8 million get us 18 years of future benefits? How does it fund that?
I can't tell, I don't know offhand how exactly the numbers came out, but what we would have done is made a projection of what all the benefit payments would be for, I guess, current retirees and upcoming expected retirees. And it adjusted it for implicit rate subsidy. So that also factors into it. But I don't know offhand what those numbers actually are.
Now, I can just add here, we're roughly coming into 2021. Townships is paying about $122,000 a month for the retirees. So I just did that over 96 months, take that out about 8 years, that's like $11.5 million. So I think starting with a pot of money of 7 million, taking out 120 a month, add back in investment returns. And again, that assumes that the population of retirees stays relatively flat. That's a non-actuarial answer to your question, Tony.
No, it doesn't. I mean, it doesn't answer it because now you're at 8 years instead of 18 years. So I don't know how you get that far out, but it doesn't matter. To me, that number is never going to enter into any of the analysis that we do.
No,
Because we're going to try to have it more of an economic issue than a regulatory issue. I mean, when we frame the arguments or frame the recommendations.
okay.
You agree with that? I mean,
Yeah, and just keep in mind too, when we make the projections of quote benefit payments, we're not necessarily looking at premium payments that the township makes, because for GASB purposes, again, we have to age adjust the costs. So for example, like if you have, you're paying a certain medical premium for a whole group of people that includes actives and retirees, that premium is a factor of the overall age of the group and, you know, set by your carrier. But for GASB purposes, we have to break out what it would be for the retirees versus actives. And also, you know, for people who passed Medicare eligibility, where you know, their premium showing on your bill may show as the same as everybody else, but theoretically their costs have gone down because of Medicare being primary. So our benefit payments are not equal to the premium payments that you guys would see. So we do a separate actuarial calculation of those benefit payments.
But Colleen, having said that, though, isn't our reality, Bob Tate, that if we don't add anybody, let's take the police out of it. If we don't add anybody to the civilian population, every year our civilian population gets a year older and a year older and a year older. So at the end, we're going to have 3 people that are 64 years old and older, and the per head account or per head cost there is way higher than the average cost right now. So with no inflation, with no nothing, cost per person is going to go up over time. And that's, Colleen, that's your assumption, right?
Mm-hmm.
And that's the reality of what's going to happen, Bob. The way our agreement with Delaware County Health Services works.
Delaware Valley Health Trust. That is one of the assumptions that I do want us to reconsider when we get to looking at all the assumptions, because the growth and expense is I think it's, you know, it's definitely very, very conservative. We haven't had that kind of a trend historically. So I think if we were to lower those cost assumptions out in the future, I think we can do that.
Below 5%, you mean?
Oh, absolutely. So just for instance, I think in 2019, you had a 3% decrease.
Right. That was because that was your actual.
Right. In 2020, our premiums dropped by 3% across the board from 2019. And in 2021, it was the exact same as it was in 2020.
Yeah.
So we locked into a 2-year commitment and took a 3% rate cut across the board, medical, prescription, dental. So 2020 and 2021 rates are both flat. Well, technically 2020 would be a 3% decrease. 2021 would be a 0 because it didn't move from the prior year.
Mm-hmm.
I think 2022, 3, 4, 5, I would feel very comfortable putting in, you know, an increase, but maybe 3% on medical and vision. I'm comfortable with the drug number being where it is. And the dental, maybe 2 or 3%.
So you guys though restructured your medical plan, right, in past couple years?
We did.
The
We did in
deductible,
2017,
yeah.
introduced the high deductible plan,
Mhm.
the health savings account. So that did save us, that we did realize some savings on that. But I don't want to, this is just one of a lot of assumptions. We can address the assumptions when we get through this.
Mhm.
Um,
Yeah, because of course, these valuations are in some respects static because we're looking at whatever your plan was and whatever your history was on the valuation date. Of course, doesn't take into account things like restructuring or changing your actual medical plan itself, and other cost saving measures you might take along the way. So definitely can always look at those things.
and just to clarify, the roll forward number that we have as of, is it 12/31/20 or
Yes.
1/1/20? 12/31/20
Mhm.
is really just kind of without a lot of science behind it. You're just kind of rolling forward the prior number with the same set of assumptions.
Correct. Yeah, from this 19 valuation. So we won't do a whole new full-blown valuation until the 21 valuation that will be first used for your 2021 year-end financials. And that will be with fully updated census information, asset information, and assumptions.
And that's what I mean, we're starting that now, and but that
Correct.
report won't come out till, usually comes out in September.
Yeah. And
Colleen?
yeah, of course, we would want input from you guys on the assumptions that we would use for that report.
Oh, yeah.
Okay, Colleen, I appreciate that. We pulled you off of your explanation.
All right. Yeah. So then as far as the demographic assumptions here, for this valuation, we were using what's called an RP 2014 mortality table. And for a lot of our OPEB plans, the mortality doesn't really come into play all that much because their benefits stop when they turn Medicare age. But for this plan, since there's lifetime benefits, it does make a difference. And most likely for the new report, as well as for the pension reports, we would be recommending an updated mortality table. Since this valuation was done, the Society of Actuaries came out with some new mortality tables that were developed specifically based on public employee information, and which has never been available before. All the mortality tables we had used in the past were based on more of a general population. So we will at least be recommending that. That won't, it probably won't be a major change in the projections, but we would like to reflect that since it's now available and it's the most recent information. And you mentioned before about the terminations and so forth. That's the withdrawal assumption. It's not going to be familiar to you, most likely table T1, but it's basically a very low rate of turnover. It's not a high rate of turnover. We tend to not see on an annual basis, super high rate of turnover, but we do reflect that some people will terminate before their normal retirement date. And we also use rates of disablement because the OPEB benefits are available to police officers who become totally and permanently disabled and go on disability pension. They also get OPEB, so we have certain projections as far as how many people will go on disability. It's not applicable on the civilian plan. And we also make projections about when people will retire. On the civilian side, we just assume they're going to go when they're eligible to retire. But on the police side, we have rates of retirement that a certain percentage of people will retire each year after they're eligible. We make assumptions about the coverage level that they're going to go on after they retire. Since there are, it is possible for them to get coverage for them and their dependents. For the police, we assume people hired before 2013, that they're gonna remain in the plan they were enrolled at when they retired, and that the coverage levels they'll elect will be 15% will take individual, 35% husband and wife, 50% family. And for people hired after 13, because the family's not available, we assuming 15% individual, 85% husband and wife. For civilian employees, people hired before 1990, 40% individual, 50% husband, wife, 10% family. And if anybody hired after 1990, I think only individuals available. So we assume they would all be on that.
And Colleen, we will have an update on that assumption for the post hired on or after 2010 for non-union folks, and then hired on or after 1/1/13 for the uniform folks in the civilian category.
2010, there's another category saying?
And for, as of post 2010, any non-union, basically all of administration, we get nothing.
Oh, right, yeah.
Yeah, so I don't know if you probably already have that built in, because
That's part of, the plan provisions, but we don't need to make an assumption that people who aren't eligible won't be covered, but it is listed as far as a benefit provision. Here, this is a summary of the actual benefits. These aren't assumptions, these are the actual benefits available for civilian employees.
yes.
People hired before 14 and non-union before 2010.
Oh, you got it. Yes. Okay.
Yeah.
There it is.
So then back to the assumptions. We have certain assumptions about the age differences, how many dependents people will have, how many people's active deaths will be in the line of duty, since there's a different benefit for line of duty OPEB. And then we also just disclosed what the premiums were on the valuation date, which is the starting point of how we developed the age adjusted costs. And you can see these were all different plans at that time. So of course we would update all that for 2021 to the new plans and the new rates.
I mean, in looking at this table, some of it it's not intuitive to me. I mean, if I look at parent and a child, it's $18,000. A husband and wife is lower, it's $15,000.
Yeah.
Why? I mean, how does that happen? I mean, here, presumably parent and child is two people, the employee and a child,
Mhm.
10, and
Child
husband
is
and wife.
healthier. Child is healthier than the spouse.
Say again?
A child is healthier, requiring less medical.
Well, they're going to be 30 years younger. Yeah.
Yeah.
So I don't understand how that number.
Yeah,
that
I don't know.
Yeah. I don't.
Do we give you these numbers, Colleen?
Yeah.
And Bob, where do we get them from?
These are set by the trust. Every year, the trust provides us an update on our premiums, broken down by, I mean, these are aggregated numbers, but we have it broken down between medical, prescription, and dental. And then broken down by the various categories of individual, parent, child, children, husband, wife, family, and then further broken down by the particular plan. So the PPO, the HMO, exactly as it's laid out here. These are the breakout as provided by the health trust.
Do they do it? Do they do it by age too, Bob?
That's a great question. We don't know all the science behind the rate setting. What we do know is that it's been very competitive, and we saved money by going to our high deductible. We got a 3% rate decrease in 2020, and then they held the line in 2021. So all of the science behind that, I can't answer. That's not something that they share with us. Nor do they share the experience information. So because we're in a pooled trust with over about 100 municipalities and 8,000 or so employees in total, it's not the kind of.
You've talked about having premium equalization, and our experience was good. They gave us a rebate.
Rate stabilization, yeah.
And they've given us rebates because our experience is good. I mean, there's got to be some metrics out there they're using to make those calculations.
Oh, they have a whole host of metrics. They just don't share. They tell us each year, here's your premium for this plan, for these plans at this level. Here's your rate stabilization fund, which is just a giant credit that we can apply. So but how they do it and what they do it, we don't see those details.
So within this plan, there's no benefit for good behavior, like I gave up drinking and smoking and crack and everything else, right? I mean, kidding. But I mean, it's normalized out. There's no benefit for that. Healthy lifestyle.
What we do know is that they offer all of the healthy lifestyles, all of the wellness benefits for the entire population of participants within the health trust. As the experience improves and as the claims experience improves in the aggregate, we all benefit. I mean, and I've been to enough of their meetings, and this is this is what they share with us each year, and they tell us. And I think what we've seen at least is that the proof is in the rates as they've adjusted year over year. I did have a spreadsheet I shared with the group a good 6 weeks ago, maybe, which showed historically our rates with Divot over, I think, the last 15 years. And the increases are so nominal.
Tony, this seems pretty much in line with some of your questions, correct?
Say that again, Jay.
What we're discussing now is a lot in line with some of the questions you have here.
Well, yeah.
I mean,
Bob, I guess I don't understand. Colleen is saying, at least 2019, when this report was done, people's expectations were that medical costs were going to go up 2.25% higher than general inflation. And I think Colleen said that's probably conservative, but directionally, that's kind of what people expected. And here we are, flat to declining. And it's because we're lucky. It's because our population is so good, and the Delaware Trust population is the county trust is so good. I mean, it doesn't make any, there's some disconnect in my mind as to how this can happen over an extended period. So either the 5%, the 2.25% over inflation assumption for medical care is a complete bust, or we're missing something as to why we're staying relatively flat in this kind of an environment.
So you're focusing more on these premiums, not the overall actuarial calculations, but just our premiums and the way they've behaved.
Yeah, I'm trying to connect, kind of the actuarial calculation methodology, which, I mean, we can argue about the assumptions, but I think the underlying methodology makes a lot of sense to me, except in a couple tiny little places. But how can we be so far off with our experience versus the assumptions that go into the actuarial calculation?
Yeah, I mean, some of it may be the fact that, the township has made some tweaks to the actual plan provisions over time, or, the actual medical plan, which, don't really, so in other words, if you just kept the same plan, that PPO plan with the same deductibles and everything forever, if the insurance companies even offered it forever, you would more likely see the, industry increases of 5% per year, or actually in some cases higher. We actually use higher assumptions for some plans for the short term, especially whenever the, Affordable Care Act first went into place. But it may be that the townships had better experience because of making tweaks to the plans over time. I remember, years ago, a discussion that may have also resulted, and Bob, you can correct me if I'm wrong, that we had actually sat down with somebody from the insurance trust and talked about the fact that in this plan, they do stay on the township's plan beyond Medicare eligibility. And at one time, the participants or retirees were not required to necessarily file for Medicare. So whenever the township started, mandating that should have hopefully reflected in a overall reduction of the premiums, because Medicare was becoming primary and the township's plan only had to pay the difference. So things like that have occurred over time, could have resulted in the overall year-to-year increases being less than a regular plan would be if you kept the same plan over time and didn't make any changes to it.
I got you.
Yeah.
But I mean, we're at a point in time now, we have a number. If we don't have any tweaks or fixes going forward to change our expenses, then we're going to start looking like some percentage of medical inflation in our plan. Our costs are to go up some percentage over general inflation.
Yeah. Yeah.
Okay. And Bob, I mean, there's three places where money goes that we've talked about things, and I'm not sure what goes through the expense we recognize. One is we pay people who've taken the high deductible, we pay them money, correct? Second thing is we pay people when they're on their spouse's plan.
Correct.
And the third thing is we get these rate stabilization credits. Now, do those three things all go through the audited financial number for OPEB expense every year, or are they in different pockets and not included there?
So the township's contribution towards the health savings account goes through our general ledger as a healthcare expense. The incentive to opt out of the plan and pay someone because they're covered by a spouse, that goes through payroll because it's taxable wages. And the rate stabilization fund is not reflected in the premiums. Rather, it's a credit that simply runs through our healthcare premium expense line items as a reduction of the total bill month after month.
So none of those three things go through the OPEB expense?
No, because correct. And the healthcare opt-out would not go through because that has nothing to do with, it only becomes a factor for OPEB if they come into the plan. That's a true payroll cost that the township, a benefit that's provided for those who opt out. The rate stabilization fund is not shown anywhere in the rate tables that go into the valuation. And that number can be about between $250,000 and $300,000 a year.
Oh, are there very many retirees that opt out, or are they not able to opt out and get cash?
No, we don't have anybody doing that now.
Okay, yeah. So
That's a
if
benefit
they're-
for the actives.
yeah, okay, yeah. If the retirees were allowed to opt out and take cash, we would want to value that, you know, if it was a significant number, we would value a certain percent take an opt out and what that cash payment would be, because it's still, even though it would be paid out of payroll or whatever, it would, or the general fund, it would still be an OPEB liability. But yeah, if the retirees aren't eligible for it, then it's not something that we would reflect in the OPEB valuation.
I guess in actuality, some part of that rate stabilization credit is earned, if you will, by people that are retired.
The rate stabilization credits are determined based on the overall plan performance of all the participants. And then it's doled out in some manner. Each participant gets their respective share. So I would, if we're going to tinker with some assumptions, maybe change an interest rate here or there, you know, expenses down a little bit. That's an easy one, but I would not try to tinker with the rate stabilization because it's not, it's too variable. And it's something that it could be here one year and it could dramatically change in the next. I think it would introduce too much volatility into the actuarial calculations.
Okay,
We could have a very bad year and not get any rate stabilization credits for a given year.
that's a discussion for another time.
Yeah,
I don't understand the metric. I don't know how it happens.
yeah. They assign us a credit and they say, you want to roll the credit or do you want to apply it against current year? And the last 5, 6, 7 years, we just apply it. And out of our, I mean, it basically equates to not even a third of our monthly premium or a quarter of our monthly premium.
Okay.
So it's a small factor.
Okay.
To in my opinion. Now, Colleen, you can look historically at our rate stabilization fund credits and you know, if it's something we can talk about or try to delve into, but
Yeah, I mean,
I feel like it's
Yeah.
gambling, and I don't want to gamble with this number.
yeah, we've had that discussion internally and it kind of came to the conclusion, it is almost like too erratic of a thing to be able to try to predict, and that it could just go away. We don't know if it's something that you're just going to get that year or you're going to keep getting, and there's no, because like you said, you can't see the numbers behind how it was determined, if it was because of experience or because your rates were set too high in the first place or whatever the case may be. It's like kind of impossible to predict.
Right.
That's actually in your sensitivity analysis here, correct? Which we don't need to get into unless you need to.
Yeah, well, the sensitivity analysis is where we look at what the difference in the cost would be by using plus or minus 1% on the trend rates and the interest rates. Yeah. And then we also use an assumption relative to how much of the deductible is going to be paid by the township for each person. And at the time of the valuation, we were assuming $1,125 would be contributed by the township for each person in the high deductible plan. And then the only other, that's an assumption pertaining to the life insurance. So those are the assumptions that we were using.
Okay, and again, I took you off of your brilliant discussion before with the assumption questions. So if you want to get back to that in the interest of time.
Yeah, so just, yeah, the things that we, the input I would, I guess, be looking for from the group would be, relative to the trend rates. And, depending on what you guys decide as far as a funding policy, then we could take another look at the discount rate that we'd be able to use. And probably, and maybe some of the other things, if you had any thoughts on any of that, maybe as far as the coverage levels. I don't know if you have any data that would change any of that. But a lot of these things are just kind of, things like the mortality and all that are just kind of what we use across the board. So, yeah. So if you were to be fully funding the plan on an actuarially determined basis, we would go use an interest rate as high as the long-term expected rate of return on assets, which is 2% higher than what the discount rate we're using right now is. That would make 2% difference in the interest rate would make a big difference in what the liabilities look like.
Colleen, for Tony's benefit, he just stepped out. Could you just say that last part again, please?
Yeah, I said, so if you were to develop a funding policy where it would turn out that the assets would be fully funding all future benefits, if that was the long-term goal of the funding policy, we would use a discount rate as high as the long-term expected rate of return on assets, which is 2% higher than the discount rate we had been using in the valuation. That would make a big difference on the liabilities. It would significantly reduce the liabilities of the plan. So that would be a big factor. And if everybody was in agreement that the trend rates could be reduced, then that would also serve to reduce the liabilities of the plan. And of course, because also there's no benefits for new hires on the civilian side, and the benefits for new police hires are less costs, that will also over time reduce the cost of the benefits for those people.
Now, Colleen, if we're gonna adjust any of these economic assumptions, this is something that would be built into the 1/1/21 valuation.
Yes.
Now, prior to doing that, is it feasible? I don't know if this is possible to do, but if we wanted to take a look at the roll forward number, which I think, I was just going to pull that up. Is that something that, unless you have it handy?
Yeah, here it is.
So
Really good with this, Colleen.
what's that?
He's really good with this. I don't do this anymore. I have no idea how this all happens. Like, you've done a great job.
If we were to give you maybe some proposed changes, is it something that you could update this roll forward? And so therefore, when we're looking at the balance of 12/31/2020, net OPEB, 48 million. Is that something we could see a change in that number if we tinker with some assumptions? How difficult is that to do, I guess is what I'm asking.
Well, yeah, I mean, as far as being able to report on the 2020 financials, that we can't really change that at this point, because the roll forward has to be based on the same assumptions, at least, as far as the GASB requirements, as what was used for the valuation. That's the basis for the roll forward, which was the 19 valuation.
Oh, I'm not looking to change the audited statements.
Oh, okay, yeah.
No. I'm not looking to change what's published and.
Yeah. Well, so yeah, if you wanted to model some other assumptions, Yeah, we could run it. I mean, we could just run it based on the 19 valuation, which we would have to do to roll it forward to the end of 2020 anyways. But so yeah, we could do that. We would rerun it as a 1/119 with the alternate assumptions, and then we could roll forward too. But I mean, even if we showed you what it was as a 1/119, you're going to see the impact. Ideally, though, we would look at those modeling numbers on the new valuation, but I understand if you want to look at it now, we would have to use the 19 baseline, but 2021 could be totally different, depending if the census demographics change at all. And also, like you said, if the underlying new premiums are much lower to start with.
What's the difference between these, the 2019 balance, the 2020 balance, and the net OPEB liability on the other, was it
Evaluation.
section 5? Yeah, it was 4.66, I think.
So for the 2019 valuation, we're just taking a snapshot as of January 1st, 2019. And then for reporting, so these valuations are only done every 2 years. And that, so for reporting at each year end in the audited financial statements, we take the liabilities as of 1/119 from the valuation, and we just project them forward 1 year or 2 years, whichever year you need, based on the assumptions. So theoretically, those liabilities go up. But then as far as the assets, which is the planned fiduciary net position, that's just another word for the assets that were in the plan at the time, we take the actual number off that was the market value of the assets as of that date. So the liabilities are projected, but the assets are actual. And then when we do a new valuation, we will totally update all the liability numbers with new census and new assumptions and that kind of thing. So, but since the valuations are only done every 2 years, we take the old valuation, just project it forward. We don't update for like terminated, newly terminated, newly retired, deceased, or anything like that.
And the administrative expense is what?
That I assume was just payments made out of the trust fund for, administering the plan. I'm not 100% sure what that was. We probably just took that right off of the account statement for the trust fund.
Yeah, we pay payment to PFM as the investment advisor.
Oh, right. Yeah. Investment management.
The investment management fee. So it's each month, one fee for civilian pension, one for the police pension.
Not for the pension, for the OPEB, right?
And then one for the OPEB.
OPEB. Yeah.
Okay.
Yeah.
But what's the difference between the contributions employer and the benefits paid?
So the contributions would be just the actual, I guess, deposits that the township made to the trust fund for the year.
That's exactly right. That's the money that, yep.
And the benefit payments is more like an accounting notation of, I don't know that those benefit payments were actually paid out of the fund. It's more like just reflecting an in and out, because there is an OPEB trust fund of what the premiums were for the retirees.
I guess I'm still, I mean, why aren't they the same number?
Well, actually, the number was, the idea is that we should be putting in a lot more than the pay-as-you-go. So, and I think if we went back another valuation, we would see, correct me if I'm wrong, Colleen, but I think the employer contributions exceeded this based on the previous funding plan that was proposed.
Yeah.
So we're paying Delaware County Health Fund. We write them checks. How many dollars did we write to them? $1.6 million or $1.8 million?
The contribution, which would be what the township put into the trust fund, and that could be regardless of what the actual premiums were. I mean,
Right, it could be any number we want. I
Right,
understand.
yeah.
I got that now,
Yeah.
yeah. But is $1.6 million the premium we paid to the health fund?
No,
theoretically,
million-
that's theoretically the premiums that were paid for only for retirees for all OPEB benefits. So it could be to Delaware Valley, it could be to the insurance company for the life insurance, any of that stuff.
Yes.
Okay, I got it.
Bob, this is Emily. I have a question, possibly for you and Colleen. I know that when other municipalities evaluate their post-retirement plan benefit payments, they pay attention to whether there's a trend in the retiree population in relocating from outside the township. So for instance, if there was a big trend of retirees to take off and go to Florida or to someplace where costs were higher, is that something that we have paid attention to in the past? And if we have, is that something that we need to maybe consider? Or is the trend more that people tend to stay in the general Radnor Township area?
Good question. I know there are a couple people who are not local anymore. I don't think we've had a tremendous amount of movement among retirees. From time to time, we hear about, someone, maybe a change of address, or I can say over the years, it hasn't been something on our radar.
Okay.
So
Yeah, I was just wondering if maybe there was, whether we should start paying attention to whether there's a spike or in cost after retirement, and if so, is that due at all to geographic factors?
our retirees have been pretty stable since 2014. The average cost, and this is just on a global basis, average annual cost has fluctuated between a low of 16,200 to a high of 18,300 per year. Last year it was 17,900, and this year it's projected to come down a little bit. So I think, over the long haul, when I say long haul, I'm looking at the last 8 years, not too much volatility in the overall retiree cost.
Well,
That's
darn.
an aggregate of all, that's the aggregate. So someone could move from, and we've had this happen. This has been a situation that's occurred more than once. A police officer was retired, and he retires single and then gets married. Depending on what year he retired, he can add his new young wife and kids to the plan. That's happened. But in general, the volatility is, it's not, we haven't seen a lot. And
Bob, you're not adjusting that for head count. You're just adjusting that for retirees. You don't know how many people are, how many eyeballs are insuring, right? In that number.
That's exactly right.
Yeah.
Correct. I don't have the number of belly buttons, as I said. Yes.
Yeah.
Okay.
But under the trust, they are still covered if they leave the area or whatever, correct?
Yeah, I mean, we're obligated to cover them no matter where they go. Right.
Right. Right. But I think, yeah, back to that question, though, I know we have some other municipalities where their actual plan, because it's a regional plan, will not cover people who go to another state. And so if they committed to retiree coverage for that person, they sometimes we'll have to buy a separate, more expensive policy to cover them for wherever they went to. But under your plan, the trust will still cover people who move out of state or whatever, and there may be some underlying underwriting of impact of that potentially, but maybe not, but because your plan covers them the same as everybody else.
Mhm.
Sorry about that. I just had to rejoin. So I missed some of that, but I appreciate everybody answering that to the extent that I could hear that.
Can I go back and ask a question again about the benefits paid from the trust?
Mhm.
If we have a husband and wife who are 30 years old, and we have a husband and wife who are 64, does the trust bill us the same amount for those two groups, for those two couples? Or do they distinguish by age?
Are you talking active employees?
I mean, everybody's in the same plan, right? Whether they're retired or active, it doesn't matter.
Not exactly. If you take two people or two couples in the exact same plan, regardless of age, it's the same premium if they're under the exact same coverage. I know, are you thinking back to when the Affordable Care Act was first introduced, and there was talk about doing a rate structure, separating out rates by age. We had a lot of talk going on about 6 years ago about that. And that whole Cadillac tax and all that stuff has since gone by the wayside. But the rate, if you take, in your example, Tony, if you're in the exact same plan, premium is exactly the same.
Okay, so this is a number. They don't bill us this number. We calculate this number based on
No, they bill us every month by participant, by plan.
Say again.
Every month we get a bill, an entire roster of actives, entire roster of employees, the plan that they're in, and then the rate per the coverage that they elect, whether single, married, family.
Okay, so and the rate they charge is independent of age.
Correct.
I got it. Okay.
Yeah, but then that comes back to us having to delve into those different ages. I mean, that we do make those calculations of what the age-based rates would be. So we come up with a separate per person cost for each age. In fact, going back to the valuation, we take those rates, we look at your demographics, and we try to come up with theoretically what the underlying per person cost is at each age. And that's
I
here.
saw that. And that's certainly a lot of work, and it makes sense, but that's the right way to do it.
Yeah. And yeah, we don't get that information from the trust or the carrier either. We just try to, develop that based on, basic information that we have about the age adjustments. So,
Right.
yeah.
Okay.
Yep. And I just happened to find before the meeting this little chart that I came up with years ago that Bill asked me to put together, because we did something similar for the police plan, just showing difference in like the projected benefits and whether or not you decide to pre-fund or not. And this is, it looks kind of like a silly little illustration, but it gives you the idea of the impact of, pre-funding and the interest impact and so forth. But so, if you would just look at somebody who would like join the plan in 2012 at age 25, they work 25 years to retirement, but nothing is paid into the plan ahead of time while they're working because we're only looking at the retiree benefits. They retire in 2037. That employee and their dependents receive their medical, dental, vision, all that, and life insurance and everything. The annual cost for their first year of retirement for their family coverage is 81,000. Now we're projecting out to 2037, keep in mind, with increases, 81,754. They keep getting that each year with the increases. And then in the year 2045, at age 58, they drop down to husband and wife coverage with an annual cost at that time of 124,959 per year. And then continues on till they turn age 64 with an annual cost of 201. And then you just go on and on until they get to, Medicare age. And then as each one passes away, until the last person getting payments, the spouse dies at age 88. And then the total retirement benefit payments over the joint lives of the retiree and their spouse total $6,183,197, all being paid from the general fund if you did 100% pay as you go for working the 25 years. And then we looked at the other scenario where you would be pre-funding it if you were putting in contributions over the course of their career for that same person. If we determined that the annual contribution to be put into the fund was $26,764 per year being contributed and earning interest at, I don't remember what exactly we were assuming here, but at some rate of return on those assets, with the goal of getting $1,811,000 by the time they retire to fund their benefits. And with the same scenario where they're paid out those same costs, you would theoretically fund their contributions over their career, and the total benefit payments over the joint lives would still be $6,183,000, but the total contributions you made would be much, much less. In fact, the total contributions shown here over 25 years of 669,000 is funding 6 million in benefits. So the idea being that you're funding it for 25 years and earning interest on it so that it pays for itself after the person retires, as opposed to, putting nothing in and paying the 6 million out over time from the general fund. So I thought that was just interesting to bring back out, just to give you an idea. So anyways, but I don't know, did anybody else have any other questions though on the valuation? So we have other tables where we break out, just for the police employees, the breakdown of the cost between the medical, prescription, vision, dental, life insurance. Of course, life insurance is typically going to be the lesser of all the other ones, and medical, of course, being always the most costly of them. And then for the civilian employees, the same thing, with the breakdown like that.
So I think, just for my benefit, this is just to understand exactly how these values are calculated, so we understand what goes into them, all the assumptions, etc. But I think, Colleen, once you head out, we'll continue this conversation. And I think what the rest of us need to do, Bob, and let me know if I'm right or wrong, is figure out what the problem statement is. As far as, I would think first we have to determine what we propose the policy be, or do we have any insight as to whether we even want to keep this policy? The option is, if we keep the policy as is, this is what it is going to cost. Or we can look at options, different options, as far as not offering the exact same benefit or tweaking it in some way. And then we can discuss the funding piece once we confirm where we're going with that. Is that correct? Or is it just funding?
I think that, given that these benefits are collectively bargained with our unions, so that non-union folks, unless they were hired a long time ago, are going to get it. The non-uniform civilian union group Those who had the benefit, I mean, they're going to get that, except for those hired after 1/1/2013. The police all get the benefit, again, except for those hired after 1/1/13. Now it's just husband and wife. We've been down the collective bargaining road. I think it's something that we're going to revisit every time the contracts come up for negotiation. But for our purposes here, I think we have to work under the assumption that the benefits are in place. That's a whole separate challenge for us to tackle. And when we do, and if we're successful somewhere down the road, it would certainly could dramatically alter not only the OPEB liability, but whatever proposed plan there is. I think we have to focus on proposing a plan that speaks to the OPEB liability as best we know it today and what we think, where it's going to be.
Okay.
That's a great point, because that did come up back in 2012 and 2013 when we were doing going through this same process. And it was at a point when the contracts with the civilian employee group was coming up, and it's not something we could just simply take away. That's a very difficult negotiation. But to negotiate in that future employees do not get the benefit, we were successful with that. And with the police, to limit it to husband and wife only and not the full family, we were successful with that. And I think today we currently have probably maybe 40% of our police force, 35 to 40% have been hired under that new benefit. So there is some good news on that front, but I think we got to work within the constraints of the liability as best we can, or as best we can work with the assumptions and provide Colleen a set of assumptions that gives us a number somewhere between 48 million or somewhat less. But
if we come out with a number that's 48 million or a little bit less, I would just give them the same report that was given to them in 2013. Nothing's changed.
well, you're right, Tony, whether it's 48 million or 38 million, it's a big number.
I think the first thing, Lauren, to your point, first thing we need to do is convince ourselves when we say, here's what we see the future stream of cash flows that are required to pay OPEB. And we all agree that, yep, these assumptions are rational, yada, yada. So now here's the problem we have to solve. Then we can look at the funding issue. But until to me, if we do come up with 45 million again, I think we're done. There's nothing that can be done.
Well, but the number's a number. You're right. It's like an aircraft carrier. It's not going to turn on a dime. I think, though, what we've been charged
But do we
with,
want it to? I guess that's my question is, if somebody says the apple's going to cost $5, we can say $4.75 or, $4.50. We still have to pay for it. So do we just need to figure out how we're going to pay for it?
Yeah, that's
two separate arguments or two separate issues running parallel. We're always going to challenge the cost of the apple.
Right.
That's an ongoing, that's going to be this administration and all future administrations will have that challenge, and they have to confront it. With that being said, that challenge currently today is a $48 million liability. Whether it's 48, 45, or 43, or 40, whatever we come up, whatever the number ends up being, the real task is, do we want to fund it? And if so, how much? We don't have to be as aggressive, or we could choose to be. If we want to aggressively fund it, where's the money going to come from? Are we going to ask the board or present to the board that, or let me say this, propose to the board why it would be prudent to raise taxes today to fund this future liability over the next 25, 35 years.
So I don't know how long we have Colleen, but she was going to go through the pros and cons of pre-funding since nobody does it. I realize that we have a lot of money here in this township, so we're lucky too. But just to confirm, Colleen is not the person selling us these policies. She's just the actuary, right, Colleen? I'm not trying to talk.
Well, not
Right.
just, not just.
Yeah.
I did not mean any disrespect at all. I absolutely promise you that. But what I'm saying is, so
Right.
we're not here to negotiate. Like, we can pretty much just accept the, I think it's good for us to pressure test the assumptions that go into this calculation, but plus or minus $5 million, whatever, we still have to pay for it, right? So I guess my question is, I just want to be very clear on what is the problem. The problem is, should we start paying for it now or wait? And if now,
Well,
how much? And how?
Problem is we have a giant liability on our books. And
That's what we're trying to get to.
Okay,
We're
I just
trying-
didn't know
we're
if we
trying-
were trying to cut it down by changing the policy. I mean, there's a lot of options here. But if it's
Yeah,
just limited to how much should we pay today, then that's an easier conversation.
how much should we commit to pay each year, year over year, towards, so we reduce the liability? And knowing that all civilian folks will someday, there will be no civilian calculation in this thing.
Mhm.
You'll be much older than me when that happens, Lauren, when that occurs. But we will have a finite group of police officers who, and just our labor attorney was involved in discussions way back in 2012 and 2013, just simply to come in and give a little background on contract negotiations, police labor negotiations in the state of Pennsylvania. The long and short of what he said was that taking something away from the police, just don't count on it. It's just not, absent a change in the state law, the healthcare benefits is just not something that is that easily collectively bargained away. There's
Well,
a
we all
given-
live in this town. I don't think we're trying to hurt our police in any way. So that was not part of my question. It was just
No, I
if
know that. No,
there's a way
I
to
know.
limit the policy or negotiate better rates. I mean, I know that Colleen is going under the assumptions that are pretty generic, probably through her deep expertise of the area, much more than I have. You know, we could always renegotiate. There's so many different options. So I just wanted to know what nooks and crannies are we exploring? And if it's just as simple as how much should we pay today, tomorrow, every year, whatever, then we can just figure that out.
I think we're at step one to evaluate some of the assumptions that goes into the development of the liability. To Tony's point, whether it's 48, whether we land on 48 million or 38 million, I don't want to minimize all the work that Colleen does, but it's going to be a big number either way. I think our task is doing all of the above, evaluating the assumptions, critically preparing every time there's contract negotiations, and that's what the administration does. Carfax focus is whatever that number is, do we want to fund it? And if so, how much? You know, the most critical part, I think that the board would probably need the most guidance on is if this group believes in funding the plan, where's the money going to come from? Where can we, what kind of methodology can we put in place that says we're going to look to a certain funding stream year over year? And that's a huge task. And that's why the options are pretty wide open. But having this background and all this information as to what goes into the development of the liability, I think has to be the starting point.
right. Colleen,
If we end up with a projection that says ignoring inflation, the OPEB fund or the OPEB annual requirement is going to be 3 to 5% of the total Radnor budget every year.
Mhm.
And if you convince yourself, I mean, inflation at the end of the day, the commissioners are stuck. If inflation is 5%, they're going to have to start raising taxes because the world's saying, everything's worth 5% more. But in a no inflation world, if we're at 3% of the budget, and our projection is no inflation, 3 to 5% of the budget will go to OPEB, I would look at that and say, geez, why would you ever fund this? If on the other hand, and I think this is what happened in 2013 based on the assumptions, it got to the point where OPEB could be like 25% of the budget. It's at some point in the future, and you say, oh my God, how do you ever pay for that? That's two completely different scenarios. I think it's the former that's what we're going to see when we dust all this off. That it's 3 to 5% of the budget as long as we can see forward, and we can live with that. Why would you ever pre-fund it?
So a couple of reasons why, municipalities look at the liability and try to address it, whether it's from pre-funding or just trying to reduce the liabilities, is a couple of things. The most common one is, because of that unfunded liability on the books can impact their, bond rating or, borrowing rate. So, that would be one reason. If that's not an issue, then sometimes it could be just public perception that they're, if people look at the financial statements and see that there's a huge liability on the books, it may, raise some concern. Those are a couple of reasons to look at it, but the reasons, I guess, that potentially you might want to additionally fund it, in addition to like reducing those numbers for those two reasons, might be to save money on the future costs, because theoretically, if, like I mentioned before, if you're funding it over their career and that all the money is there to fund their retirement benefits by the time they retire, then you're paying it out of the trust fund and not out of the general fund anymore. And that's hopefully going to reduce your actual costs, in the long run. Some municipalities don't feel that's an issue or a problem. The premiums they're paying and the retiree group is manageable. In your case, you might have a little bit less manageable group because of having the lifetime benefits. So your group's just going to keep getting bigger and bigger, theoretically, over time, and therefore the total premiums for the actives and retirees is keeps growing. And but if it's sustainable based on your cash flow, it may or may not be an issue. So those are all the considerations that would go into it. Then if you come to the conclusion that you think it would make sense to pre-fund, then yes, then you would decide how you want to come up with what to put in each year. And if you were doing it in a way like the pensions are done, you would be making a payment each year equal to the normal cost. That keeps you up to speed on not increasing your liabilities, because you're paying each year what the additional new cost is of people earning benefits, and a payment on the unfunded liability each year until that gets paid off, once the unfunded is paid off, and then you're only putting that normal cost each year. And that's kind of what the exercise we went through that last time, years ago. But it's really, those are the things I guess you would want to take into consideration, and whether or not it makes sense for the township to do that pre-funding or not.
And Colleen, just for clarification, when we talk about the unfunded versus the normal cost, the unfunded refers to all of the costs that have been promised in prior years when there was no money set aside.
Right.
So it's
Less the money that is actually set aside so far. So yeah, it's the current liabilities minus the current assets.
that unfunded actuarial accrued liability.
Right. So to reduce the unfunded liability, you could, number one, reduce the liability, which is difficult to do, like you said, because it'd be hard to negotiate down the benefits, but you could do those other tweaks with the assumptions, with the benefit plan itself, with the co-pays or whatever. Then the other would obviously be increasing the amount of money you're putting in the plan. That would increase the assets and therefore reduce the unfunded liability.
Mhm.
So that unfunded liability, the liabilities minus the assets, that's the net OPEB liability that goes on the financials. So the more assets, with respect to the liability, then the lower the unfunded portion of the liability.
So in this example, what we're looking at on the screen, the
Mhm.
normal cost under the current discount rate, 4.25, is saying that in addition to the pay-as-you-go, the township would have to fund 1.347 million just for this, or I guess for 2019. That would be the normal cost for 2019
Mhm.
to put towards OPEB.
Yeah.
So that, and I think as we kind of peel this onion back a little further and we start thinking in terms of what's the pay-as-you-go piece, the roughly, what is it? Roughly 1.4 to 1.5 million a year. If we just did nothing and paid that piece for those who are currently retired. The piece that's normal cost, and then the piece that's the UAAL, unfunded actuarial accrued liability.
Mhm. Yeah.
That there's three components that, for discussion that I think we could look at it that way. And we could, if we could choose to fund normal cost, which then keeps us on pace. The unfunded piece will eventually, will go away. As those older folks die off, or those, I mean, we're talking a long horizon here of time. But I think these are some of the funding scenarios, if we want to start modeling, we could look at in those terms. Is that am I characterizing that properly, Colleen? Is that?
Mhm. Yeah. Because under the old GASB standards, they actually required you to show the numbers of what the contribution would be if you were getting it fully funded by paying the normal costs plus an amortization of the unfunded liability. They don't recognize that anymore, so we don't put it in the reports. But for your purposes, if you decided you wanted to fund, we could do those calculations. Like if your unfunded liability is 46 million and you want to get that paid off over X number of years, we could amortize it and tell you how much you would pay each year in addition to the normal cost to get to 100% funding by year whatever, year X.
Colleen, what are your time constraints here? Be sensitive to that.
No, I'm fine.
Okay. Is there anything else you want to add to this at this point? Bob, do we get another shot at with Colleen? Should we? I think we'll probably need it at some point, either written or otherwise. Emily texted me and she said that she has some questions that she wants to put together based on this call.
Yeah, absolutely.
Okay.
I mean, that's what we're here to do. And I know, Colleen, as long as with enough notice, we can schedule with you again, right?
Mm-hmm.
Yeah.
Right. She's not moving to Dubai or something, right?
No, it's a lot easier to schedule Zooms than it was to schedule a trip out to Radnor. So,
Right.
Did we get through all the questions? I'm looking through the list.
Tony, what are your thoughts on this?
I guess if I can get back to my my computer here, I just did that. Okay. One question I had that kind of is an overarching question. Let me see if I can find it real quick.
You had about
Here, yeah, here it is. here it is. And Bob, you weigh in on this. I looked back at the 2013 report, and I thought there, the pay-as-you-go was estimated to be $2.7 million. This is 2013 projected out. So 2020, the expense was going to be 2.7 million for OPEB. We're looking at $1.5 million, $1.8 million as the new starting point. Why aren't the liabilities a third then of what we're showing? I'm sorry, 2/3. Why aren't they reduced by a third? Just from that simple change of starting point. You follow me, Bob?
Well, it's actually half, right? 1.35 is half of 2.7, literally.
Well, whatever the number is, it keeps moving around. I just used, like in my analysis, I used 1.8, which is a third. If it's $1.5 million, it's almost half. Why wouldn't the new actuarial analysis show us being half the liability?
When you say 1.5, you're talking about the retiree healthcare premium only.
No, I'm talking about the OPEB number, the OPEB benefit payment on the accounting statement.
The normal cost?
Not normal cost, take that off. I'm just talking about, here's the pay-as-you-go number, which is $1.5 million, $1.6 million, $1.7 million, Bob.
So
What's
we
the cash
did
flow
nothing.
in 2020 for the OPEB benefits?
I see. Yeah, if we did nothing and just simply paid the premiums year over year.
Yeah.
Yeah.
What would that be in 2020? What would that premium be?
In 2020, it was about just shy of 1.6. 2021, it's going to come down a little bit.
Okay, so in the 2013 analysis, 2020 was supposed to be 2.7 million was the pay-as-you-go number.
Just the pay as you go?
That's what I'm interpolating on a chart. That's what it looked like to me. It was 2.7 million. And now we're looking at $1.6 million or $1.7 million as the cash cost. So I would think the whole liability would drop by a third.
I follow your logic. I don't know if that translates cleanly into the actuarial calculation, though.
Colleen's still on the phone?
I'm here, yeah. I wasn't sure what that 13 number you're talking about came from. Was it from one of our reports or something else?
It was something that the Carfax team back in 2013 gave to the township supervisors, the commissioners. And they had a chart and they said, you know, here's all the different options and here's pay as you go. And I interpolated, I kind of had it interpolated. It didn't say here's the number. I interpolated 2.7 million. So now we have the starting point. 2007 is our current starting, 2020 is our current starting point. And it is going to be 2/3 of what it was projected to be last time. So if nothing else changes, it would seem to me that we ought to, that in the total liability ought to be 2/3 of what it was then. And we're not anywhere close to that.
Yeah, that part I can't answer. I think we got to, I don't know. I'd have to look at yeah, I don't know. I don't have a good answer for you on that.
Yeah.
Okay, I mean, that to me is a huge issue. And Bob, I hear our job is to come up with funding options. Has anybody said to the board, here's what this benefit costs the township?
Sure. Oh, sure.
No, what do you mean, oh, sure? I mean, like, if you said, anybody ever go to him and say, here's the funding that we are contractually obligated to do. It cost us X. Here's the stuff we're doing because it's the right thing to do as an employer. We made promises to people, we should keep them. It costs us Y. There's nobody else coming in that's got any kind of expenses. Any new hire has none of this expense except for the police. Continuing that benefit for the police costs us Z. Isn't that information they should have?
Well,
I mean, I hear, I'm not saying we renegotiate anything. I'm just saying, this is, these guys are responsible for a whole lot of money. You've said that there's certainly an issue to be made that, my neighbor across the street just moved into his house and he's going to fund a $43 million liability the township has. He just moved into the township. It's his problem now. And the answer is, well, yeah.
you're not, Tony, you're hitting on a great point that was debated among the prior group.
Sure.
Great deal.
It's fair. I mean, it's a fair question to ask. I mean, I'm not suggesting it's not. It's a fair question to ask.
It's a very fair question. The board, way back when, was presented, an overwhelming amount of detail, as you saw in that presentation. Over the years, the board has changed. I mean,
Sure.
new people coming and going. So they probably don't get it, or it hasn't been given to them in the manner you just described, but it is reported to them via the budget and via the annual financial report. And it's probably done in more of a global sense than it is in the detail level that you just mentioned. I think the work of our group right now and the product, whatever our end product is, there will be an opportunity to do exactly as you described. Here's the fixed set of assumptions. Here's the group who's going to benefit. Here's the liability, and here's what we recommend. And that's a great opportunity to have discussions about why, should the new guy moving in be saddled with this liability? Great question. Normal cost. Yeah, I think it's fair to say the normal cost is part of, that any taxpayer who lives in the township, because that's today's current cost that's being funded for the future. You're getting into the great points that I think those are all great questions. Ultimately, we have to come kind of thresh all those out and decide what's the direction. I mean, pay as you go is an option.
That's fine. And
I mean, pay as you go is an optional recommendation. Anywhere between pay as you go and what we were trying to do prior to 2019 and COVID, I think that's the landscape we're operating in.
So, I mean, just for Bob, to reiterate what you've been saying all along, certainly in the tone of the last several months, is we can't just come back with a pay-as-you-go option. We think that's the best one from the get-go. We really have to research that, because that's kind of what they came out with last time. So, we should at least explore several options and defend them as to the best one.
Pay as you go was not the option last time. It was no. You mean from 2012?
Well, they're putting away some money now, but not lately.
Well, we were right. It was ramping up every year.
Right. So right now we're pay as we go.
This year and last has been pay as you go.
Right. My point. That's
correct. Yeah. 2020 and the budget for 2021 is a pay as you go option, given the hit that we took. Again, it's whatever this group
right
is where we're at.
Okay.
They're all great arguments. I can agree. I can get behind each position. They're all there's validity in every one. But that's not my call. I'm here to help facilitate it.
Colleen, could you, not almost a flick of a switch, could you take the 2019 projection and run it out 25 years by year with 0 inflation.
You mean just like basically changing the discount rate?
No discount rate, no inflation in the expenses.
Oh, just basically projected benefit payments.
The adjustments are only people that come and go. So head count would change, but all the other stuff that's having an impact on it,
Mhm.
go on. It's just, here it is, no inflation, if that's what it was, and you know, in the number, you know, presumably it's going to be somewhere between $1.5 million and $2.5 million for most of that period, maybe all that period.
Yeah. Yeah, we could do that. Then the question would be, you know, like I was kind of explaining before, that when we actually do our calculations and project those costs or the quote benefit payments, we use the age adjusted premium information or age adjusted costs. So that's going to be different than the actual premiums that the trust charges you. So the question is, which way do you want to look at it? With the projected premiums that you will have to pay for those people, or our projected costs for those individuals on a age adjusted basis? But yes, we could do that.
Okay, Bob, why don't you take a shot at answering that, Bob?
Mhm.
Which one to use?
Yes, should we use age adjusted premiums or average premiums?
I'd have to look at, is there any way we could look at historical data to see how age adjusted, and not now, but I mean, it's something maybe you can get back to us, Colleen, to see how have the age adjusted premiums correlated with the actuals. If there's a significant variance, then I would prefer to use the one that whatever method is closer to actual. So if the age adjusted is just giving us a terribly inflated number, and we use the historical trend, I would, for comparison purposes, I'd love to see that. I think ultimately for the report that you provide to the township has to be done within, you know, the certain, within the GASB rules.
Yeah. Well, yeah. So yeah, here's something else to think about though, and looking at it that way, is when we reflect the age adjusted premiums, we're doing that because of the fact that you have retirees in your plan that are older on average than your active people. So the way I sometimes explain it is that a little piece of the premium you're paying for all your actives is attributable to the fact you provide a retiree plan because you've got retirees there. You know what I mean? So if they're underwriting your plan because based on the overall age of everybody that's covered, actives and retirees, they may tell you your premium is X for everybody in this plan, but they're spreading across the board. But behind the scenes, they're rating you based on the average age of that whole group. So that, you know, 20-year-old employee that you're paying the same premium for as the retiree who's in that same plan, if you didn't have the retiree, that active person's premium would probably be a lot less if they were rating you just based on, you know, the active only group. So built into some of the active premium is the cost of your retiree OPEB plan. And that's why we do it that way. That's why we age adjust the costs and reflect that implicit rate subsidy into the benefit payments for the retirees.
Is there any way for us to, I guess, just measure if, or I should say validate that process? Or is it, I guess in accounting, it's like the old balance sheet approach. Where are we today? And then that's, if as long as we know our starting point today, everything is then calculated going forward. Is that, because isn't that what you really do with the OPEB liability? You say you take a point in time and say, based on all the facts and assumptions we know as of today, and just recast it. Is that right, Colleen?
Yeah, pretty much, yeah.
So I mean, I guess, Tony, the only way to really answer that question is, let's run it both ways. And so, do we have any basis for choosing a smaller number? I don't know. I have no idea. Like that's,
For our gap books, we're using a lower number.
for our books, I think we're gonna be locked in based on what GASB requires. But for the funding plan, we could, you know, it may not, I don't know if it necessarily has to be matched exactly, because at some point in the future, we're gonna have enough assets to cover the liability.
Yeah, here's the only way I guess you'd be able to more closely be able to verify our age-adjusted numbers would be as if your carrier was able to separate your rates and say, and start charging you a separate rate for your actives than your retirees. That would be the only way to like truly determine whether or not we're making the proper adjustment for the different ages of the retirees versus the actives. And that's, you know, probably not going to happen. I know there's some other trusts, like the one trust that our company administers, we do have separate retiree rates, which makes it a little bit easier, but it's still, you know, a trust level cost. So it's still a little bit, to some extent, aggregated with other participants and municipalities in the trust, but at least it gives you some sense of how much the retirees impact the premiums, you know, versus having only actives.
Okay.
Yeah, I don't know if that's even possible to do that, but if they were able to re-rate you and come up with just active premiums that they charge you for the actives and then retiree premiums, then that would, you know, tell you, because behind the scenes, they are rating them and charging the premiums based on age. It's just that they're aggregating it as a big group and just giving you one across the board premium. But had you not had retirees, that across the board premium would be, I'm sure, less.
Right.
Okay. Any other questions? Are we questioning out or what? Huh?
You have 2 more hours?
Well, not tonight. That was my point. You know, as long as Colleen's not moving off to Dubai, and even if she is, we appreciate your time, Colleen. We don't want to keep it's 8 o'clock, and we don't want to kind of life you out of outside of this. So we appreciate your time.
Yep, no problem.
Was this helpful, guys? I'm sorry that we couldn't have more of our team here, but
Oh, it's very helpful.
good, Emily. That's great. Thank you. All right. Tony,
Yes.
I know I can see you're simmering over there. I can read your mind. I know you. That's okay. But for now, I think we've got a little bit more vantage, right, from different views. And Colleen, thank you for taking us through this. It's very, very helpful.
No problem.
Thanks, Colleen.
Sure.
Lauren, anything else? Emily, anything else?
Not at the moment.
Okay.
Does someone need to make a motion to adjourn, or do we just?
I make a motion to adjourn.
Second.
Thank you. Thank you. And you second it, right?
You guys want to at least, do we have some next steps?
Right.
I mean,
So
our next,
I thought, are we letting Colleen go and we are continuing to chat for a couple minutes just to figure out where we're going next? Or no? So no.
Sure. We're on a recorded line, so
Colleen will be in touch.
Okay, sounds good.
thank you.
Okay,
Thank you very much.
everybody.
Colleen.
Thank you.
All right, have a good one.
Good night.
Thanks, Colleen.
Yep.
So we're on a recorded line. The idea is we'll have a sub-team meeting, perhaps in person, but we can discuss that not on a recorded line, okay?
we can schedule that at your convenience and whoever is available to join us. I appreciate you guys who have been, let's just say you're the go-to starting lineup, so to speak, being available for these meetings.
Yep. Okay. Let's circle back on this. Tony, are you thinking from your vantage a couple weeks? We should probably get Rob Norton involved in this too. Thoughts? We're on a recorded line, but let's circle back by email, shall we? Our next steps are to circle back by email.
Jay, can you maybe just send out you want to send a recap to our group?
Of all that? Sure.
No, no.
Why not?
It was recorded. We just tell them to watch the recording.
Exactly.
We can't get them to come to the meeting. I don't think they're going to watch it.
I know.
But I'm just thinking a brief email that we talked about OPEB, we reviewed
Yep.
the information, and we want to plan a work group meeting.
Yep.
And maybe between now and when we get together, we could prepare for the next step we want to go to.
So if we're thinking about this like CFOs, we've confirmed that our financial statements are accurate. We just need a strategy for how to make them better. Fair?
The financial statements are accurate. We want to improve our net asset position.
Yeah.
Correct. That's
Okay.
exactly right.
Tony might question them, but
So-
we're gonna leave them as is.
I think the whole analysis, the whole actuarial analysis is biased towards getting a big number. I mean, it's conservatism on top of conservatism. I'm not saying anybody's evil doing it. It's just the way it works. And you make all these conservative assumptions and the sucker blows up like this. And you say, oh, what do we do? What do we do? And so I think it's incumbent upon us to get a number that we think this really makes sense from an economic standpoint for the township. What we have now is good accounting, and we have, we're going to get a good report, but I'm not sure it's the number that we ought to say, geez, we got to get that number funded because
It's overstated.
it can't be done.
Tony, I think you bring up a great point because the last go around, the focus was, that's the number and how do we get there? And it was that chart that went out over 30 some years, ramping it up every year over year over year. And I think, like I said, everything's on the table.
Yeah.
But
I don't know how the process works, but we certainly need to change the investment allocation for the OPEB assets. I mean, what we have now makes absolutely zero sense from any perspective. We've got a fund that we're not going to be taking cash out of there for a long time. So there's no need to have all this debt and cash and life insurance policies. It ought to be 98% equities or move in that direction. How do you get that? How's that conversation work with the township commissioners to approve that sort of thing?
Similar to tonight, I would propose that we have our investment advisor from PFM join us on a call, and we can step through the most recent report on the asset allocation, the investment performance, and just focus. I mean, that would be a very, very finite type of review because it's set amount of assets, the set asset allocation, looking at performance, and then a discussion, which would then become a recommendation to the board. We go through the manager to change our investment policy statement relative to OPEB, and they would have to adopt that. But I think before we jump to that point, I think it would be helpful for this group and we don't need to take, 2.5 hours. We typically have meetings and only because we've been doing it, we do it every quarter and we review the pension plans, the OPEB plan. But he could step through within a half an hour. everybody will know everything about the OPEB trust fund, where the money is, how it's invested. And we can discuss changes and what the impacts might be, and hear from the investment advisor, the pros and cons of playing with that mix. I think of having that first before we just jump into some recommended change. I wouldn't want to do that until the group
Again,
has.
you know the process, and I think Jay, from our perspective, Liam and Rob Norton, I mean, this is what these guys do for a living.
Yep.
So we certainly want those guys here to look at this stuff.
Agreed.
And I'm not suggesting, Bob, that we ought to just flip the switch tomorrow, but I would like us to get permission from the commissioners to say, you're right, we ought to be 90-10 or 95-5, you know, and we'll get there over the next couple, 3 years, you know, and do it in small bites as opposed to, you know, one big jump.
No, that's a great point. That
We have left a lot of money on the table over the last 7 years.
well, yeah.
But we really have. It should have been invested differently the whole time, but we are where we are, and you know, if we can get this going in the right direction.
Let me reach out to our advisor and I'll just reach out tomorrow and just give him a heads up that at some future meeting at some date, we'll try to coordinate with them, and then you guys can hear directly from them. Maybe hear some more technical things that I'm not maybe conveying, that I'm not on my mind right at the moment regarding the funds and how it works. And then we can make it, you know, make that kind of recommendation, having all of that information before us. Yeah, and again, these are all the little pieces. I think I'm really glad we did this, because we're getting into the details. And
Yep.
you know, if we change the investment mix, we change some assumptions, yeah, maybe that 48's down to 38, you know, and maybe a funding plan that is over 45 years instead of 33 years. Who cares? Like, but
Well,
at least-
it makes a huge difference. I mean, from these reports, it looks like this is the worst case scenario, which is kind of where I was going with that. Like, these are the numbers. We're not going to redo the numbers, but we could say, look, based on this, you've got two options. And, you know, by the way, we thought of a few assumptions that might affect Advantage, and which we might give you some more options. So that might be a recommendation, is that we look at it, changing these assumptions, which make more things possible, right?
Well, why don't we do this? Could we take a look back at what we just went through, and looking at Tony's questions, if there's a particular assumption or a couple of assumptions that we want to change, why don't we share via email, and let's get together a list of all agreed upon proposed changes and assumptions. And then
We're not there yet, but I agree. We'll get to that. That's
right.
the stage.
Yes, and then,
I mean,
but what I'm thinking is I wouldn't mind having this rolled out for the 1/1/2021 valuation, which they're about to begin, which we'll have that report in September.
okay. All right.
I mean, I may be wrong, but I can't imagine that the 2-year change in our population makes that much difference. I mean, kind
Well,
of for
it's
what
just
we're
a different
doing.
look at the assumptions, right? I mean, the numbers, the baseline is not going to change. The data is not going to change. It's just a different way to look at it. Do we have to pay extra for that?
We do pay fees for them to do the work, yeah.
Is it $25,000?
No.
Uh,
No,
If,
no.
Bob, if money goes into the trust, it can only go out as an OPEB payment.
It funds the OPEB and it funds the investment fees and the costs.
And I don't mean it that way. I mean, if we fund it and then we decide, geez, we never should have funded any of it. Everything should be completely pay as you go. You can't ever get out that money.
Well, we would use that money to pay premiums. That would, we
Okay,
could,
yeah, okay.
yeah, we would burn through that money in a year with what's in there now.
Are we getting any money from the settlement for the COVID relief bills? The township get any money for that?
Yes, the township was notified, I guess maybe 3 or 4 weeks ago, that every municipality, there's a whole listing that's been published of every municipality throughout the state and what they're going to receive. Radnor's going to receive 3.15 million.
There it is. There's our number.
Half of it this year, and then the other half coming next year. So that's we're waiting on that to come in.
Okay.
Yeah.
Okay. Shall we wrap?
We wrap,
Making a motion to wrap.
wrap,
And
seconded.
Wrap. Thank you all. Thank you.
Yep.
Thank you, Bob. Mr. Tate,
Bob.
thank you
Thank
very
you,
much.
guys.
All right.